All right. We're just going to give it a couple of minutes while people are filing in. Hello, everybody. Dave and I have been chatting. It's been a little while since we talked, Dave. I mean, we were in Miami together in January, right?
Right.
That was a great time, great location. Everybody, I was sharing with Dave after that. There was no part of me that wanted to fly to Miami, and even in January, and I brought my wife along, which is always a treat. But that city won me over, and I can't wait to go back. So, I had to set my grumpy self aside and say, let's go out and enjoy it. And what a great time. I'm one of those people that I love the idea of traveling until it comes to, a few days before, and you think, oh, there's so much to do. But I can't wait to go back. And you always run a great program. And it was great to have Ed there as well. See you two together.
Yeah, that was great.
Yeah. Okay. So it is 6:30. So I'm going to start. I want to welcome everybody and joining us on the first YouTube webinar I've done in some time. But tonight is one of our special webinars, and we have a special guest, David McKnight. So if you want to say hello, David.
Hey, everyone. Thanks for having me.
I didn't ask you. Are you at home in Puerto Rico, or where are you today?
Yep, home in Puerto Rico. I just did a speaking event in Fort Lauderdale last night. I love those events because I can go to Fort Lauderdale, speak, and then come back all within a 24-hour time period. So
that's great.
Yeah,
that's great. Well, I hope it's nice and warm there because we're still in winter here.
Yeah, it was about 80 degrees today. So certainly what I would qualify as warm. So can't complain.
Andrew asked, we have a question already, and Andrew asked, and I think if I remember, Andrew, you've got family in Puerto Rico, but he's asking, where in Puerto Rico do you live, Dave?
I live in Dorado, which is about 25 miles west of San Juan.
There you go. Andrew's going to be stopping by to visit.
All right.
All right. So I want to remind everybody that you are being recorded. I know you get an announcement when you come on, but you are being recorded. If for some reason you don't want to be recorded, you should sign off now. The benefit of the recording is that we're going to package this into a YouTube video. It's going to be available on our website at outofourwealth.com, and we're going to ship it out to you via email. You are going to have an opportunity to ask questions throughout this discussion. We'll be talking for about an hour, maybe a little longer if it turns into that. We have a lot to talk about, and just like Andrew popped in and asked where Dave lives in Puerto Rico, you can just write your question as we're going. I'll check in periodically and address the questions. Don't wait until the end because you might forget or we just might not see it. But if we get it answered for you, just type back that you answered our questions. So there is that Q&A available. There's also that raise hand. So if you can all do me a favor and just raise your hand if you can see us and hear us okay, that would be great. If you can, and you got to click the rate. Some of you are doing that. That's good. I had a woman, Dave, that was a regular on my Tuesday webinars, and she said, I used to just raise my hand and I thought you could see me. And then I just didn't realize that you had to push the raise hand button. So we had a bunch of people raise their hands. We appreciate that. Speaking of weekly webinars, you all probably know, but I'm going to tell you again, I host a weekly live webinar most Tuesdays. The only days that I don't do is when I have time to take vacation or after a market holiday. But most Tuesday things at 10 a.m. I host a webinar, and we go through many topics. It's usually about 45 minutes to 50 minutes long, but we talk about a series of updates from the Ed Slott Elite Advisor Group, where we talk about retirement distribution issues, and there's always plenty to talk about there. I go over market returns and read some analyst reports, give my thoughts about that, and then we have a financial planning topic. And we're going to talk about the financial planning topic from this week, and that was the title of it was The Future of Social Security, and we had some really enlightening things that I would say nothing new, but it kind of stacks on to some of the concerns we have about the future health of our government as a whole, Social Security and Medicare and different programs. But Dave and I are going to talk a lot about that tonight. But pay attention to those weekly webinars. People find them helpful, and subscribe to our YouTube channel. So I have a YouTube channel for Attleboro Wealth. It's always great to subscribe so you get notification when we have new webinars, because they're now hosted on YouTube, not on Zoom. And Dave, we were talking about, he's really became very active on his YouTube channel and does some great YouTube videos about all different kind of planning strategies and talking about, you know, some of the naysayers out there and giving our thoughts about it. And he's really our representative of on the right side of things, in my opinion. So I appreciate that, Dave. And just to plug one other thing for Dave is his podcast, the Power Zero podcast. Is that title right?
Yep.
Yes.
Power Zero.
I listen to that every week, or at least I listen to every episode. Sometimes I catch up, you know, a couple weeks at a time, but they're always great. And if I'm telling a secret, sometimes that gives me the inspiration for my own webinar after that. So I would, if you listen to podcasts, find Dave's podcast. You know, you can find it anywhere, and spend some time with it. And we've got a couple things coming up that I want to tell you about. So we've got a series of the Changing World of Retirement Planning classes, also written by David McKnight, the best retirement planning class, bar none, in my opinion. And the next class series, we just finished one at Villanova University, and we have another one starting March 16th at Holy Family University, right directly across the street from our office here. And then on May 16th, Dave's going to be visiting us here live at the wonderful Newtown Theater with another special guest, Ed Slott. So we have the two big hitters of effective, tax-efficient retirement planning in the United States joining us one night on May 16th at the Newtown Theater. And on top of that all, we're going to have great food from Chef Joe Garvey at the same time. So come out and see us. All right, it's time to introduce Dave. He's patiently waiting. So we were talking about all the books Dave writes or has written. So he's written The Power Zero, Tax-Free Income for Life, Look Before You Learn, The Volatility Shield, and the new Infinity Code, which I explained to Dave that I read on my trip to Iceland. They're all excellent. There is one other that you shared with me that you wrote before all these, right? It was a fiction work. Yeah, so that's great. What was that one called?
That was called the Tongue of Fire.
Okay.
Yeah, it was. That's what started it all. I wrote that back in 2012. It took me 2 years to write it. And, you know, they say the greatest learning experience when you're a writer is writing your very first book, because it teaches you more than any of your other books exactly what is required from A to Z to get the book actually published. So yeah, it was just 2 years after that, of course, that I wrote The Power of Zero. So even though that fiction book was not a business book per se, it helped me understand the process I would have to go through when I wrote The Power of Zero.
Yeah, well, The Power of Zero is what started it with me. And I always talk about two aha moments. And when I just want to say it again for you folks who haven't heard it, but, you know, when I first earned my certified financial planner designation, I was feeling really good about myself. And I was clicking around on TV when we used to scroll, and I saw Ed Slott talking on PBS, which he often does, raises a lot of money, millions and millions of dollars for PBS. And I had heard Ed speak before, read his books, and something resonated with me that day. And I went to the website, you know, his website, and I saw that he was doing a continuing education course in Newark, New Jersey. And Dave, you've been to Newark, right? Who wouldn't love an opportunity to visit Newark? Right? No offense to anyone who's listening from Newark, but so I made the trip to Newark, and within the first hour, sitting in the back of the class of that 2-day course, I realized there was so much I didn't know, and I had been missing from my clients. And I had been in this business for over 10 years at that point. Again, just achieved my certified financial planning designation, which is very difficult. You know, 50% of the people who take the exam don't pass. So you know, it was enlightening and eye-opening for me, and it changed the course of my practice and certainly the direction for my clients. Then I had another episode like that when I was in San Diego, California, and I at a slot education event we have to attend twice a year, and very stringent requirements to stay involved in Ed's elite advisor group. And I'm now I've been a master, part of the master elite advisor group for a few years now, if not 5 years or more. But I came back to my desk or my table, and I'm sorry, I don't have one here. It's in the other room and I don't want to get up. But there was a book in front of me called The Power of Zero. And shortly after Dave got up and presented to the room of 400 of us and won me over again. And I thought to myself, oh my gosh, because I had learned so much from Ed and I didn't have a way to present it or distill it down for folks to understand it. And Dave answered it like that in his book. And we talked shortly after that. And he told me about the Changing World of Retirement classes that he had developed, and the rest is history. And so I appreciate everything you've done for myself and my clients, Dave. So let me give you a little bit of background on Dave. So David McKnight graduated from Brigham Young University with honors in 1997. Over the past 22 years, David has helped put thousands of Americans on the road to the 0% tax bracket. He has made frequent appearances in Forbes, USA Today, New York Times, Fox Business, CBS Radio, Bloomberg Radio, The Huffington Post, Reuters, CNBC, Yahoo Finance, geez Louise, NASDAQ.com, Investors Business Daily, Kiplinger's, MarketWatch, and numerous other publications. Dave's best-selling book, The Power of Zero, has sold over 300,000 copies, probably more now, and the updated and revised version was published by Penguin Random House. When it was launched in September of 2018, it finished the week as the #2 most sold business book in the world. For 2 consecutive years, Forbes magazine has ranked The Power of Zero as a top 10 financial resource in the country. This book was recently made into a full-length documentary film titled The Power of Zero, The Tax Train is Coming. When his follow-up book, The Tax-Free Income for Life, launched in November of 2020, it finished the week as the #3 top-selling business book in the world. Dave and his wife, Felice, have 7 children. So Dave, welcome again. Anything
Thanks,
you want
Mark.
to say after I've been talking so much?
It's always great to be with you, Mark.
Thanks. All right, so let's dig into it. So we've got a list of topics you and I talked about, and let's start really simply and I just want to ask you, it's been a little over a year since we did this last time. So the first question is, what's different today? What should we be paying attention to today?
Yeah, so last year this time we had 4 years until tax rates were going to go up. We know that the Trump tax cuts are slated to expire December 31st, 2025. So we had 4 years during which to take advantage of historically low tax rates, which means that here we are a year later, which means we have 3 years during which to take advantage of historically low tax rates. And you and I have talked about whether those Trump tax cuts are going to get extended for the middle class or not. My thought is that they are, but there's no guarantees in life. So if you're looking to take advantage of historically low tax rates, you now only have a 3-year period within which to do so. Remember, every year that goes by where you fail to take advantage of historically low tax rates is potentially a year beyond 2026 when you could be forced to pay tax rates that are higher than they are today. And that means, the real life implications of that are that your money's going to run out faster. Okay, so anything you can do, there's lots of different things that you can do to help make your money last longer, and they all have a cumulatively meaningful impact. But one of those things is paying taxes while they're historically low. And if you fail to pay taxes, whether it's through a Roth conversion or making after-tax contributions to a Roth IRA or Roth 401k, every year that goes by where you fail to do that means that you've missed a window of opportunity. And so I'm all about getting the message out on why it's important to take advantage of tax rates while they're low, particularly because Mark, you and I have talked about how tax rates in the future have to rise dramatically to keep our country solvent. So I would say that's the big difference. The window of opportunity has narrowed.
Yeah. And one of my favorite parts of your class is when we do what's referred to as the final exam. And I really connect with the Wile E. Coyote story. And I always talk, and it truly is one of my, you talk about it in the book, and it's even in the movie, I think, right?
Yes, I believe so.
Yeah. So, but it is one of my favorite episodes because it's one of the few times that the coyote talks, right? He's usually silent, and he refers to himself as Wile E. Coyote super genius. But it's it's so, when I was teaching a course at Villanova, I like every time we're talking about this Roadrunner Wile E. Coyote situation and that pulling down of the window shade, right? And so many people are still doing that. And I've had to set aside my frustration, and because there's a few people that we can help one-on-one, right? There's only so many people we can help directly. Hundreds of people attend these classes, and you hope that they're awakened a little bit and do something. But the masses are just going to find themselves on that railroad tracks, and unfortunately, they're not paying attention, or they just pull the window shade down and they say it's not going to happen to me. I wish there was something that we could do to, well, I guess YouTube videos and things like that help. But, we were talking about how everything that we say, it gets reinforced all the time. I was talking to one of the students from the class, and he said, I talked to my financial advisor and his CPA, and he said they don't think taxes are going to go up. And my question always is, or my response always is, when someone says to me, especially another professional, is that I could probably give you about a dozen reasons why taxes have to increase substantially, if not double, over the next, now we're within 10 years, right? Just give me one real reason why they won't have. Not I don't know, there'll be some kind of catalyst, nothing that, something meaningful, that just one reason. And nobody has ever been able to give me a good reason. So let's talk a little bit about some of the reports that came out over the past couple weeks. That the Congressional Budget Office and the U.S. Treasury had some really important things to say, and they're saying it again and again and again. And I hope that people start paying attention. But do you want to take that and talk about some of the things that came out from the government reports?
Yeah, so there's really two things that really stuck out in my mind. And that's that, well, this year there was $1.4 trillion, $1.4 trillion deficit, which means we had to borrow $1.4 trillion just to be able to pay our bills, which basically means we added $1.4 trillion to the national debt. One thing that was interesting, and I've long predicted that this was going to happen, is it says that we will average $2 trillion per year of debt starting in 2023, going through 2033. So what does that tell you? That tells you that if we're at about $31 trillion of debt right now, we're going to be, by 2033, add another $20 trillion to that. So we're going to be at $53 trillion. When you're at $53 trillion, you're fast approaching the moment in time when all of the revenue flowing into the U.S. Treasury at that point, under today's tax rates, will only be enough to pay the interest on all that debt, let alone any principal, let alone a single dollar for Social Security, Medicare, Medicaid, or any of the other expenses of the federal government. And so that was one thing that really stuck out. The other thing that really stuck out is they projected out over the next 75 years. And these reports are only allowed to project out over 75 years, but it's always interesting to see what type of sustainability our federal government has over that time frame. In theory, you want to have a sustainable approach to finance over whether it be a 10-year time frame, 20, 30, or even 75. All the smart people in Washington, all the economists say that we should have a debt to GDP ratio, in the mid 60s. Okay, it's predicted that by the end of that 75-year time frame, in that Congressional Budget Office report, we're going to have about 575% debt to GDP ratio. Now, that's obviously, we would be bankrupt years before that ever happened. There'd be a Great Depression years before that ever happened. But that just shows you sort of how steep the curve is of unsustainability for our federal government. And you know what's driving all that debt? It's not pork barrel spending. It's not even the military. It's basically three things: Social Security, Medicare, and Medicaid. We have promised way more than we can afford to deliver for those programs. And in order to be able to pay that, we can either dramatically increase tax rates, we can dramatically reduce spending, or some combination of the two. If we do nothing, then that debt to GDP ratio starts to climb at a really dangerous level. And as David Walker, former Comptroller General of the federal government, says, he says that could be the death of our republic.
Hmm. That's frightening. That's really frightening. So, you know what? There's some questions I want to cover, and one of them is really when we talked about when tax rates will go up, and I want to talk a little bit about my thoughts about the extension of the tax cuts that you were talking about, the Tax Cuts and Jobs Act, referred to as the Trump tax cuts, and how my own thinking has changed. And Dave was about a year and a half ahead of me. But you know, I always come back to if these things are stacking up and it's getting more obvious. Dave and I were talking at some point, and I believe that the government's going to wait until the last exact moment that they can to act, because there doesn't seem to be the courage in Washington to do anything. And by the way, we don't allow them to have the courage, because if Dave said something, there's got to be changes to Social Security and Medicare. Dave can never, ever, ever run for Congress now because he said that in a recorded session. And if he did, somebody would grab that and say, Dave McKnight wants to eliminate Social Security and Medicare.
Mark, I actually did a podcast a couple of years ago, maybe a year and a half ago, where what I would do if I were president.
Yeah.
And it would be raise revenue, reduce spending, or some combination of the two. And what would I do? The first thing I would do is I would modify Social Security. I'd push the age out for people like you and me, Mark.
Yeah.
I wouldn't touch it for baby boomers. I push the age out for people like you and me and younger. Modify social or Medicare. So yeah, I'm all over the record as having said, you know, the entitlement program should be modified and modified dramatically. So yeah, I have basically ruled out any political career from here on out.
Yeah, that's for sure. But you know, we as the you know, the electorate, we have to allow our we can't just complain about politicians doing nothing. We have to allow them to do nothing. And I'm going to try to stay off the soapbox, but you know, if we just hit somebody all the time about talking about changing Social Security, Medicare, any entitlement program, without really listening to the next part of it, because what Dave just said and what most people are saying is we're not going to touch it for the baby boomers, the people that are planned for it and relied on it. But I don't know of anybody in my generation that's really counting on it. And I would certainly accept the first collection age to be, you know, 67 instead of 62, and I'm just spitballing here. You know, the full retirement age to be 72 instead of 67, and maybe if I wait until I'm 75 or 80, I get the most. So there has to be adjustments. And by the way, I'm 100% in support of raising the cap on the income that's counted for Social Security. So these are things that all make sense, but we let the politicians get drive us into fear about losing these benefits. So we as the electorate have to be a little more graceful about allowing our leaders to do something. So I'm going to end that soapbox discussion. But so what do you think? So what I was talking about, Dave, was the extension of Trump tax cuts, or the Tax Cuts and Jobs Act, and that's slated for 2025. And you say it all the time: if Congress does nothing, you know, we revert back to 2017. And a year ago, I heard you saying on the podcast and one-on-one that you thought that no matter who's in office, right, Republicans or Democrats, and you tell me if I'm misrepresenting what you said, you think that those tax cuts will be extended. Now, I don't think Ed agreed with you at that point, right, Ed Slott? And I didn't agree with you, but I have to tell you, I do now, because politically, I see that it's a terrible economic move for us, but it's a good political move for the party that wants to stay in power or take power. So you've won me over on that. There's a lot more people talking about it. So talk about that a little bit if you can.
Yeah, so you can stay in office by sticking it to the 1%. You can stick it to the wealthy and still be elected year in and year out. But you can't stay in office if you alienate the middle class. And even if you let the 22 and 24% tax brackets revert back to the 25 and 28 respectively that they were pre-2018, that would still be perceived as a tax increase. So you did not vote to extend the Trump tax cuts, therefore it's perceived as a tax increase. And neither Democrats or Republicans want to be perceived as having raise taxes on the middle class. And so whoever's in power will likely, if I were a sort of a betting man, which I'm not, but if I were, I'd say they're going to extend the Trump tax cuts. Remember, they're going to do it under budget reconciliation because to make it law, it's, takes a super majority, but they'll do it under budget reconciliation, whoever's in power. They just need, in the Senate, you need a simple majority, so 51 votes. So they'll extend it for 8 years, which means if they do it in 2023, that means they'll extend it through 2031. If they do it in 2024, they'll do it through 2032. And we'll all have to deal with the repercussions, the financial repercussions of doing so, because those tax cuts won't be paid for and it'll add to the debt. And which means the fix on the back end, if there is such a fix, is going to be even more draconian, even more aggressive. So I don't think there's anybody at this point who thinks that the middle class is going to have to start paying 25 and 28% tax rates again. But like I said earlier, there's no guarantees in life, but that's just from my vantage point, that's where I see things headed.
So when we get to the point of no return, right? When like we talked about, when the country comes to us and says that there's a crisis, and just like during COVID, and if I'm repeating this on this broadcast right now, I apologize. Dave and I were talking about it before, so I just don't remember. But at some point, 2030 around, the government will come to us in crisis mode saying we have to do something. We pushed it all the way as far as we can, and now to save our country, we have to increase these taxes. And there's going to be other increases around. Dave and I were looking at a chart before we started that showed the amount of individual taxes collected by the government. And I'm holding, for those of you just listening, I'm holding up my fingers as wide as I can. And the small amount collected by corporate tax. So even if you doubled corporate tax from 300+ billion, that would only get us 600 billion. And even if you took it all the way up to $1 trillion, that's still way beyond, or way below, excuse me, what we need in tax increases. So we only bring in about $4.1 trillion in tax receipts. And our costs per year right now, 2022 fiscal year, actually, so not even right now, are about $9.1 trillion. So there's a big gap there. So if taxes if the Tax Cuts and Jobs Act is extended and we come to crisis mode, what do the tax rates look like, Dave, in your opinion?
Is this broadcast rated PG, PG-13? What is this rated?
I think that's YTD, yet to be determined.
I know people say, Dave, your documentary, The Powers Here, the Tax Rate is Coming, got a PG rating.
I saw that. Yeah,
why is parental guidance suggested? And the reason it got a PG rating is because it has adult themes. We're talking about apocalyptic type tax rates throughout the course of the movie. We're talking about the implications. What would happen to our country if we had to raise tax rates to the levels that would be required to pay for Social Security, Medicare, Medicaid? So it's not pretty. David Walker, I like paying attention to David Walker. He was a former Comptroller General of the federal government. He resigned back in 2008 because he didn't feel like Congress was listening to him. Began crisscrossing the country, sort of trying to raise the warning cry to whoever would listen. And basically what he said back then was that tax rates have to double to keep our country solvent. He even put an actual figure on it. He says by 2030, effective tax rates would have to double across the board. That means that everybody, lowest tax brackets all the way up to the highest tax brackets, would have to double their tax rate. I don't know how sustainable that is, and I don't think he thinks that's sustainable either. But that's if all you did was raise taxes and you didn't cut spending. So the reality is there's going to be some combination of raising revenue and reducing spending. But I think the days of people getting away with the 10 and 12% tax rate, I think those are going to be long gone. I think that the lowest, it's going to go back to sort of what we had back in 1960, where you had the lowest marginal tax bracket was something like 22. The highest marginal tax bracket was something like 88, and that might be for any dollar you made above and beyond, I don't know, $1 million or something like that. But the point is, we are going to turn into I don't know quite how to put this. We're going to have socialist type tax rates. I did a video on this. We're gonna have tax rates like they have in Denmark without all the goodies. So you'll have 50% tax rates, but you won't have paid sick leave. You won't have paid maternal leave. You won't have all the goodies that they have in Denmark. You're just going to have to pay 50% tax rates. And all that extra money is just going to go to service the debt or to pay down the debt or to pay for Social Security, Medicare, Medicaid, what have you. So it's fairly apocalyptic and nobody likes to talk about it. Nobody likes to think about it, but the math is not pretty and the math doesn't lie.
Yeah, well, I tell you what, I feel very fortunate because I have the opportunity to be involved in Ed Slott's Master Elite Group. There's only 400 of us. There's a few over 400 now in the entire country, and that always amazes me that more people who call themselves financial advisors, planners, or professionals aren't involved in this group because it's, you know, there's most of us work with baby boomers. There's 70+ million of you, and this is the most important part of your lifetime retirement planning. So I've got a good group of, and I think Ed's group and Dave certainly, but Dave has a group, you know, the POZ or Power Zero Elite Advisor group as well. And like I said, we were all just down in Miami together. Ed was there, Dave was there, and a group. What was the size of the group you had there? Were there 50?
We had about 75 advisors.
So some of the best thinkers, I think, in the retirement planning space today, certainly the tax efficient retirement planning space, I have the opportunity to spend time with and discuss with this. And my feeling is, and even some of the others I talk to, is that your average middle class American is going to be in the 40 to 45% effective tax rate when these changes go through. Because Dave mentioned the 20, I think you said the 22% rate or the 25% rate and the 88% rate, but he didn't mention the middle at about 63, right? Is it, if I'm remembering what the Congressional Budget Office projected, right? Some time ago, and that's where most of us live, right? In that middle. Most of the country lives in that middle. So you can see when you kind of pan back and look at the projected rates, even if it's just 3 or any iteration of that, they can make it 5, but it still has to fall on those numbers. Most of us are going to be in the 40 to 45% effective tax rate if you don't.
And you're referring to that Congressional Budget Office study where they basically said, I believe the 15 becomes the 25. The 25 is this back when there was a 25. I think 25 becomes a 63, and then the 35 becomes the 88, something to that effect. You average together, you know, the effective rate, if you're paying a portion at 22 and a portion at 63, you're going to be in the mid 40s, something like that. I think that's what we're looking at. And this is not to try to wax apocalyptic or to be sensational or inflammatory. This is just what the cold hard facts are telling us. And frankly, Mark, every year that goes by where they fail to address Social Security, Medicare, Medicaid, and the burgeoning debt means that reality is all the more unavoidable, unfortunately.
Yeah, and we're being told. So, you know, the Treasury report that came out a week and a half ago from the U.S. Treasury, the term was an unsustainable fiscal or financial situation that the country's in. And this isn't the first time that's been said. It's been said over and over, and going back at least, you know, 3, 4, or 5 years. So it's almost like that Surgeon General warning that I assume is still on a pack of cigarettes. I don't smoke, but the Surgeon General stamps on there that basically, if you continue to use this product, you're going to have horrible things happen to you, and people still do it. And we are constantly told, because anybody can go on and retrieve these documents. It's not secret for, you know, anybody in financial industry. You can, you know, we've got this thing, Google. Anybody right now, Google U.S. Treasury report or Congressional Budget Office report and pull down, you know, the U.S. Treasury report is only, and maybe I haven't reversed, but the executive summaries are only at most 10 pages. So it's worth reading if you have an interest in the future of your retirement at all. But it's, you know, it's certainly, we're headed in that direction. Now, you talked about David Walker, and we talk about David Walker a lot, and he's a great resource. But what are some of the other experts out there saying? Because I know you really keep your
I did another video on 8 experts that have predicted that tax rates are going up. These are all people that we've heard of before, and I'm going from memory here. So you had Leon Cooperman, who is a hedge fund manager. You have obviously Ed Slott, you have Ray Dalio, you have, gosh, I can't remember. I had 8 of them in there, and they're basically all pointing to the same signs, which are Social Security, Medicare, Medicaid. They're on this unsustainable trend. And if we do nothing, it will necessitate a dramatic rise in tax rates. So it's not like there's just these few lone voices in the wilderness that are crying out, take advantage of low tax rates. It's getting to the point where you can't really find anybody anymore who doubts the tax rates down the road. And I love to share this story. I apologize if I've shared it on your podcast before, but there's this guru out there who calls himself the white coat investor. And he and I got into it. He wrote a scathing review of The Power of Zero right after it came out. He said, does it make sense to be in a 0% tax bracket? No, because tax rates in the future are not going to go up. Tax rates over time have ebbed and flowed. They're low now. They may be higher later, but they're going to go down again. And I basically said, look, that's an outdated paradigm. Tax rates go up when it's wartime, they come down in the post-war period. And that has been sort of the history of tax rates. Well, we're marching into a future where that paradigm is going to get discarded. And so he and I sort of argued back and forth on over the series of 4 or 5 blog posts. And he basically said, look, I think we're just going to print our way out of it. And I said, look, you can't print your way out of it because Social Security, Medicare, and Medicaid are all indexed for inflation. If you print your way out of it, inflation is going to go up, and the cost of those 3 programs is going to rise commensurately. So you can't do that. So we sort of left it at that. And then Joe Biden was running for president. I think this was, what was it, 2019. And he basically came out with this tax plan. And I read a tweet by the white coat investor in which he said, wow, Joe Biden's tax plan reads like an all-out war on the individual investor. If Joe Biden gets elected, I am going to do a Roth conversion on all of my IRA retirement savings. I'm going to do it all in 1 year. And so let's put aside this whole notion that it's bad financial planning to convert your entire IRA in 1 year. But he was basically conceding that whether it's Joe Biden or somebody else, the specter of higher tax rates means that you should be thinking about things like Roth conversions. And so even the naysayers, Mark, like the white coat investor, are starting to come over into our camp, that it makes sense to do things like Roth conversions. He and I argued for 5 blog posts on why he thought a Roth conversion was not a good idea, and I thought it was. And now he's saying not only is it a good idea, but I might convert my entire IRA all in 1 year, which you and I both know you're supposed to stretch that tax obligation out over a lot of different years, not do it all in 1 year. So like he was giving himself bad advice. So so very, very few people are now questioning this idea that tax rates are going to go higher and higher in a precipitous way.
Yeah, one of my favorite stories is I have a client whose accountant battled me about Roth conversions, and I shared your book with him, The Power of Zero. And the following year, I had to pull him back from over converting because we said, I basically went with a recommended in the plan, whatever it was. Let's just say it's $85,000, and he came back in an email. Well, why don't we do $150,000? And I said, well, all right, cool your jets. I appreciate the fact that you did a complete 180, but let's keep him in the 24% bracket instead of skying out his. My 24 is my favorite tax bracket. 32 is my least favorite tax bracket. Because if you're bumping up into the 32, it's an 8% increase. And you're much better off stretching that tax obligation out, staying in the 24 over time. So that's funny that he wanted to go up into the 32. It's something I almost universally recommend against. I know you do. And we've talked about that before. And the good news is that I feel some relief, and I hope you're right. And I hope I'm right now, because I'm taking co-ownership of this prediction that the Tax Cuts and Jobs Act are going to be extended, with the caveat that we never know what Congress is going to do. But it gives us some grace and some comfort and not really having to rush to the end of 2025. Obviously, if we're able to get conversions done comfortably by the end of 2025 or tax efficient transfers done by the end of 2025, it gives us some relief from that tax rate risk. But I think that we can probably ease on that a little bit. And that's the advice that we're giving our clients. And I do have, it's funny because I've been explaining this to some class attendees that many people get concerned in the beginning. You make a recommendation of $100,000 conversion and they say, well, can we do 50? Because I've got to ease into this. And then often the second and third year, you're backing them off the gas saying, well, wait a minute. Okay, let's go up to back up to the 100 or whatever it is needs to be at the time and not do 300. Right, or not try to do it all. So it's an interesting progression, and I'll just remind people that if you're planning on your own or planning with someone who's not specifically trained in this, you've got to review these plans every single year, because if Emily Wheeler was sitting here with us, who's our senior financial planning associate, if I asked her how many plans we have where the Roth conversions are the same every year, she would likely say none. Right, you've got to look at it. You got to. There's always reasons to make changes, it seems. All right, so we talked about the experts. We talked about what we think rates will go up to. We talked about when tax rates will go up. Now let's shift a little bit and talk about investments. What are your thoughts about investments and what we should be doing today with investments?
You're talking about in terms of like portfolio makeup, stock bond mix, or are you talking about?
Let's stick with tax efficiency around investments.
Gotcha. Okay.
Mm-hmm.
Yeah, I think that you should have a diversified stream of tax-free income. I think you should take advantage of every nook and cranny in the IRS tax code. I think that, as you know, Mark, we typically recommend 6 different streams of tax-free income. We talk about the Roth IRA, the Roth 401k. We talk about the Roth conversion. We talk about being able to take money out of your IRA and have that distribution offset by your standard deduction, which makes that IRA distribution 100% tax-free. We talk about the LIRP, or the life insurance retirement plan, which is great because it gives you a death benefit that you can spend in advance of your death for the purpose of paying for long-term care, and the cash value is growing in a tax-free way, in a safe and productive way. And we also talk about how if you keep your provisional income low enough, then your Social Security can also be tax-free. And by the way, if you have 6 streams of tax-free income, none of which show up on the IRS's radar, what tax bracket does that put you in? It puts you in the 0% tax bracket. And the reason why I advocate for 6 different streams of tax-free income is, number one, if the IRS ever legislates one of those streams of income out of existence, you've got 5 others to buoy you up. But not only that, but each of those streams of tax-free income does something different, does something in a unique way that the other streams of tax-free income doesn't do. So for example, why do I love the Roth 401k? Well, it does something that none of those other 5 do. Namely, it gives you free money. It's a company match. A Roth conversion can't give you a company match. A Roth IRA can't give you a company match. Why do I like a Roth IRA over a Roth 401k? Because you can get liquidity on your money. You put the money in, you could take it right back out. You can't do that in any of the other investments. Why do I like the RMD offset by your standard deduction? Because you get a tax deduction on the front end, it grows tax deferred, you take it out tax free. There's nothing else like it out there except for maybe an HSA. So the idea, and then of course we talked about the LIRP as a death benefit component that you can spend for long-term care. And if you die peaceful in your sleep 30 years from now, never having to need long-term care, someone's still getting a death benefit, probably your kids or your grandkids. So you've got these 6 streams of tax-free income that you can utilize. We're talking about taking advantage of everything that the IRS is offering you. And the reason why they offer these different things is because they have different attributes that make them unique. You should be drawing upon all of those unique qualities in your financial plan, with the idea that you ultimately land in the 0% tax bracket. And you and I talk about why the 0% tax bracket is so important, because if tax rates double, like David Walker and others are predicting, then 2 times 0 is still 0.
Yeah, the tax-free distribution of your IRA is one of the most brilliant things that I will tell you that I don't know if I understood that as well as I do now until we met. And that was one of those light bulbs that came off and went off for me in 2016. I started in this business in 2001, earned my CFP in 2011, became part of Ed's group, and I learned that in 2016. So maybe I read it before, and maybe, you know, but if that can work for an individual, so that's you know, absent any other income, say absent rental income, you know, I'm a real estate investor. So if I keep my real estate investment properties in retirement, that strategy is not going to work for me. I push everything into Roth IRAs, Roth 401ks. The but when that can work, it is a brilliant strategy, and it is very confusing for people when we're teaching it in class. You always see people furrowed brows, shaking their head, not quite understanding. So it's something that has to be gone over. And by the way, I've had CPAs say, "What? You can't do that. That doesn't make sense." But what Dave's talking about is offsetting any required minimum distribution with a standard deduction, whatever your tax deductions are. Most folks in retirement are standard deductions. So as Dave said, you get a deduction or a payroll. You know, it's straight from your payroll deduction, so you pay no tax going into the IRA, and you pay no tax coming out. And when that can work, it's absolutely beautiful and brilliant and exciting and all that. And that's really one of the areas where the art has to be applied to the planning process, right? And has to be monitored, right? Because the risk is, and I talk about this, I'm probably more conservative with that strategy, Dave, than maybe some of the other folks that you work with, because I'm worried about that suddenly single situation, because actuarially, two spouses go into march into retirement together, they're not leaving at the same time, right? One's going to die before the other, and that standard deduction is cut in half. The requirement and distribution stay the same because one person is rolling over the other to the other. So I'm probably more conservative in that approach, but it's still, if you can maintain $250,000 that you never had to pay tax on, first of all, it would be a terrible shame to convert that or pass it on to somebody, you know, in a tax inefficient manner. But it's just a big mistake that a lot of people make who aren't tuned into it. Make sense?
Right. So what you touched on is this idea of over converting. So,
Yes.
you know, we talk about how, and just to make this math really easy, let's say you got $1 million in your IRA, and you convert every last dollar of it to your Roth IRA. So you've got zero now in your IRA. You've got $1 million in your Roth IRA, assuming you paid the tax on it from some other source. Well, okay, so now you come to retirement, and you're taking all of your money out of your Roth IRA. Yet you have this standard deduction, this $27,700 if you retire today, but it gets indexed for inflation every year. So you got the standard deduction that is now sitting idle. Okay, you don't have any income that you can use to offset, that can be offset by that standard deduction. So what you now have found is that you're in a position where you wish you had some money in your IRA that you could then draw from in a tax-free way by utilizing your standard deduction. So what you'll find is that you really should have, you know, like you said, Mark, between $250,000 and $350,000, because what you'll find is that that amount of money will create an RMD when you're 73 that's equal to or less than your standard deduction, but also low enough that it doesn't cause Social Security taxation. So instead of converting your, you know, IRA from $1 million down to zero, convert it from $1 million down to 350 or 250. You save some taxes along the way because you're not converting the entire thing. And then when you retire, you can then draw the RMD off of that and have that be tax-free because it's offset by your standard deduction.
So let me put my compliance regulation hat on for a second and say it's different for everybody. And it depends on your situation, because if you have other income, rental income, pensions, or something like that, then this strategy won't work. But I got to tell you, if this strategy doesn't work for you, you darn well better move the rest of your funds into the tax-free, tax advantage bucket, because you've got to protect everything else that you have. So I hope nobody out there wrote down 250, 350. Dave and Mark said I can keep $350,000 in my IRA. That's different for everybody, and it has to be assessed and reviewed. And you should review your plan every single year, like you all hear me say all the time. All right, so I'm going to ask you, what should retirees be doing now?
Well, I think they should be, at the very least, asking themselves the question. One of the most important questions I think people are going to ask themselves where do I think tax rates are headed? And if the answer to that is the tax rate at which that I'll pay when I distribute money from my IRAs or 401ks somewhere down the road, if you think that that tax rate down the road is going to be higher than the tax rate today, then you should probably execute a Roth conversion. So I would think about that. And once again, we do have 3 years until it reverts back to what it was in 2017. But between me, you, and the wall, Mark, we think that that's going to be extended, but it's not going to be extended forever. We can't extend it forever. So I'm thinking, you got 8 years or so, maybe 9 years within which to take advantage of these historically low tax rates. So I would think about potentially, and obviously this is different for everybody, but for a lot of the people we meet with, converting to the top of the 24% tax bracket. 24% tax bracket, I talk about in chapter 6 of my updated and revised version of The Power of Zero. I talk about why 24% is my very favorite tax bracket, because for 2% more than the 22% tax bracket, you can convert an extra, I think today it's 170,000 or so. You can convert an extra $170,000 to the tax-free bucket. It only costs you 2% more on the margin. So in other words, if you feel good about hitting the top of the 22% tax bracket, you should feel great about hitting the top of the 24%. And by the way, if tax rates do revert back to pre-Trump levels in 2026, the 22 becomes a 25 and the 24 becomes a 28. In other words, the future version of the 22 is still, sorry, the future version of the 25 is worse than the present version of the 24.
Yes.
So really, these are great low tax rates. So we're all on the clock, frankly. And so if I were getting ready for retirement, I would be thinking hard about whether I want to hit the top of that 24% tax bracket. If you're in the 12% tax bracket, it's a bit of an ask to say bump up into the 22 or the 24. But if you're already planning on being in the 22, don't let a year go by where you're not going to convert to the top of the 22. And by the way, 24 is only 2% worse. So why not convert to the top of that as well?
Yeah, and that was a good point you just made, because you don't have to be in the 22, 24. Good accountants will tell people to take distributions or do something if they have the opportunity to do it in 10, 12, so you should act. We talk about the railroad tracks. We always talk about at the end of our class, take the momentum that you get from the class and do something. Folks, I've got a note here. Don't wait with an exclamation point. So hear me say, don't wait with an exclamation point, because in all the years that I've been doing this now, whether it's just traditional financial planning or now tax efficient financial planning, this specialization, I've never, ever, ever had a person say, geez, I wish I would have waited 5 more years to do this. Everybody always said, I wish I would have heard this 10 years ago. I wish I would have heard this 5 years ago. So don't wait, and tell your kids about it. Tell your loved ones about it, because one of the best gifts that you can give someone you care about is this information and the ability to act on it. Because think about if you would have known, if you're 65 today listening to this broadcast, and if you would have known about this 20 years ago and had a chance to really unlearn what you've learned, because that's unfortunately what people have to do. We were taught, we are as financial professionals, and many are still taught of this, this tax deferred paradigm that we know now is wrong. We were taught this for 40 plus years, and you've heard it for 40 plus years in your working years. So you have to unlearn it, but don't wait. Just, do your planning, find somebody to help you. If you want to have a discussion with me about what your situation is, you can reach us at admin@outofourwealth.com. The contact page is going to load at the end of this webinar, but you've got to do something, get off those railroad tracks and get away from the train. We can't save everybody, but we want to save you and your loved ones for you folks that are listening tonight. Dave, let's check in with a couple of questions. You okay with that?
Sure.
Okay. Let me put my readers on. Andrew is busy tonight. Andrew asks, what do you think will be the impact on Social Security and Medicare based on that potential prediction? So this has been sitting for a while. So he's talking about I believe, and Andrew, you can clarify. I think he's talking about the zeroing, the trust fund going to zero for Social Security and Medicare.
Yeah, so the current prediction is, and just to be clear on what the trust fund is, the trust fund is all of the money that got stored up over the years that basically was saved for a rainy day. In other words, we've been able to pay these Social Security payments out through incoming revenue, but what's going to happen is the incoming revenue will get to the point where it's not enough. We may have already passed. I think we're already eating into the trust fund. And so the incoming revenue is not enough to pay the outgoing expenses. So we have to dig into that rainy day fund. Well, in 2032, that rainy day fund runs out, that trust fund. And now we've got to pay all Social Security payments based on those FICA payments that are coming in. They're deducted from our paychecks basically, right? And so what they're predicting is that there's going to be a 23% across the board cut for Social Security. Okay. Now, if the government doesn't want to do that, they're going to have to find some revenue to shore up that trust fund, and that's going to come from higher taxes.
Yeah. So I think you said 80% for Medicare and 70% for Social Security, and nobody's going to accept that. Nobody's going to accept that. All right. So Roseanne has a very specific question that I had to read twice. So let me see. I'm gonna ask you to send this to me in an email, but I read it for everybody because there's a couple of things that are important in here. As a 72-year-old now filing as a single, can I offset a Roth conversion by using QCD, qualified charitable distribution, for my RMDs? So let me take that one first. You cannot do you have to first do an RMD before you do a Roth conversion. So that's very clear in the tax law. So the QCD has to go directly to the charity. You can't receive that, and so it doesn't even hit your tax return. So I don't see how that would offset a Roth conversion. Then she said, then do a Roth conversion in an amount equivalent to the standard deduction for a single. Now, she said, this year I'm filing a single after years of filing married in the 12% bracket. So sorry to hear about your loss, first of all. And you're in that situation where we've just been talking about the suddenly single, and now Roseanne's tax situation has changed dramatically. So the QCD wouldn't work, but what you're saying about a Roth conversion in amount equivalent to the standard deduction for a single, so your tax amount, let me think about this. Yeah, I think that would work if you don't have any other income to write off that's going to already eat up that standard deduction. That would be the only caveat. Do you agree with that, Dave?
Yeah. So one strategy she may want to think about is if she's got some money in a cash account or in a taxable bucket, maybe it's in some mutual funds, what have you. She could live off of those funds. It's not going to go into her tax cylinder and consume her standard deduction or fill up the 10 and 12% tax brackets, and then she could, she could utilize at that point the standard deduction to offset. This year it would be half of 27.7, which is whatever that number is, 13.6.
Yeah, I can pull it up, and then you get another 18.5. I think it is 1850 for
right if you're over age 65. So, and then you know what? I wouldn't stop there, because the 10 and 12% tax bracket, you're going to get hit 2030 and look back on the year 2023 and say 10 and 12%. That's a good deal of historic proportions. Why did I not convert to the top of the 10 and 12? So I would say not only utilize your standard deduction, but convert to the top of the 10 or the 12, 10 and the 12 as well. I think that's a tax sale of a lifetime that's hard to pass up.
Yeah. Yeah, so Roseanne, if you'd send me that email, I'm happy to schedule. I know we've talked before, but I'm happy to schedule some time for you. And now that your situation's changed, we can do another comparison and see what makes sense for you. So happy to do that. I think you're on every one of the webinars every week, and I appreciate that. And you always have good comments. Anthony and Denise write, hello. Are there any Roth conversion options, backdoor, et cetera, or the Roth itself subject to legislation change in the future? Great question. This always comes up. So Dave, do you want to take that?
Yeah, so there had been a lot of talk that the backdoor Roth conversion, which basically means if you make too much money and can't deduct your IRA contribution, you can use after-tax dollars, and then you contribute it to the IRA with after-tax dollars. You sign a conversion form, and the net effect is that you contributed to a Roth IRA. It ends up in the same place. All you had to do is sign one additional piece of paper. There was some talk that was going away, but lo and behold, Secure Act 2.0 came out, and they did not touch it. So it's still around, and it's still something that you can take advantage of. They didn't change any of the other rules. There had been some discussion over income limitations, that if you, sorry, not income limitations, but balance limitation. If you had a balance, say, above $10 million, and this was inspired by Peter Thiel's $5 billion Roth IRA, so that if you had IRA balances above, say, $10 million, they would force you to convert a portion of that. None of that materialized in the Secure Act 2.0. So really nothing changed as far as Roth conversions go.
Yeah, in fact, things got better, right? So with Secure 2.0, so Rothification is the trend coming out of Washington. So now we have the abilities for SEP IRAs to be Roth. That wasn't the case 6 weeks ago, right? Simple IRAs can now be Roth. That wasn't the case 6 or 8 weeks ago before it came out. Employer contributions can now go into the Roth option in the 401k. That was not the situation 6 or 8 weeks ago. So it makes me feel very good about the future of Roth IRAs, because Washington doesn't think like we all do. Washington wants those tax dollars now. We're long-term planners. We understand that you've got to pay for things now and plan to pay for things later and put yourself in a better position. All they care about is their little tiny window of their election cycle of 2 or 6 years, right? So, really, really great question, Anthony. You got to be really careful about the backdoor Roth contributions, though, because if you have money in an IRA and I'm just going to give you an example, and you contribute $7,500 of a non-deductible contribution into your IRA, and then convert that over to the Roth, you're going to get stuck in what's called the pro rata rule, and only a small portion potentially of that conversion is going to be tax-free, and you're not going to like the outcome. And it's a nightmare to track. There are ways around it, and it's certainly a good technique to look at. And that is one time that you can put money back in your plan. You can, there's a lot of things do, but you got to be careful about that. But really great question. Thank you. Andrew asked a great question again. So Andrew asked, can you talk more about how life insurance could be a vehicle to be used for retirement planning? Do you use taxable monies to buy the insurance, and what kind of insurance is recommended? Good question.
Yeah, so I got a whole chapter in my book, chapter 5 of The Power of Zero, is called the LIRP. Stands for Life Insurance Retirement Plan. I think that there's some things that the life insurance retirement plan gives you. Remember, we talked about how all of these 6 streams of tax-free income have unique qualities that the other ones don't. So I'm going to tick off some of the unique qualities that I think the LIRP has. I'm also going to preface by saying that a lot of people try to position these LIRPs as silver bullets or panaceas. They're not. They serve a very particular, specific purpose. And they need to be used in just the right way, but I'll talk about some of the unique attributes. You are using after-tax dollars. The type of LIRP I typically recommend, I wrote a book about why I like this particular one. It's called Look Before You LIRP. It's called Index Universal Life. Index Universal Life, you put your money in, and the growth of your cash value is linked to the upward movement of a stock market index. Typically the S&P 500, whatever the S&P 500 does in a given year, you get to keep up to a cap, we'll call it 12%. And if the S&P 500 ever goes down in any given year, they simply credit you a 0. So you're always going to be making anywhere between 0 and 12%. Over the last 16 years or so that these types of programs have really been around in any really meaningful way. We're looking between 7 and 8% gross of fees. The cost of these programs over the life of the program is going to be at 1%. So if you got 7.5% growth, you're going to be netting about 6.5%, which is a safe and productive way to grow at least a portion of your money. And I often talk about, and Mark, you and I have talked about this before, how the LIRP can be a meaningful bond alternative. You reach into your portfolio, remove the bonds, replace it with an LIRP. You're going to increase your overall return. You're going to lower the risk, lower the standard deviation of your entire portfolio, and have a better outcome over time. So, but of course, the real crown jewel of the LIRP is that you get that death benefit. And should you end up needing long-term care sometime, you typically need it the 2 to 4 years before you die. If you should end up needing long-term care, they will give you the ability to receive your death benefit in advance of your death for the purpose of paying for long-term care. And like I said before, if you end up dying peaceful in your sleep, never having needed long-term care, then your kids, your grandkids get a death benefit. So it's not like you paid for something that you never used. And so, like I said, it's not a silver bullet. It should never be seen as a replacement for a Roth IRA or a Roth 401k or a Roth conversion or what have you. But it does play an interesting role in the balanced, comprehensive approach to tax-free retirement planning.
Yeah, great answer. And the only the thing that frustrates me about the using the LIRP, because there's such great tools and they can be so impactful, is that not everybody can do it. Right? That's the frustrating. Like anybody can do a Roth IRA who has a traditional IRA, but you have to go through that approval process. Now, if that's where kind of knowing the ropes and having the right people in place makes a big difference. And I often talk about your team, right? Having a qualified financial planner. I think that person should be a CFP, certified financial planner. I also think that person should be part of the specialized groups like Dave's, the Power Zero Elite group, and Ed's, Master Elite Advisor group. You want a good CPA in your group, and for all the reasons that I think you should have a CFP, I think it should also be a CPA and at least one attorney who's an estate attorney, and probably an elder law attorney. Not that you may be elderly, but there might be somebody in your life who's elderly. So it's good to have all these people working for you, and you want specialists in those areas. And I say this because they can be powerful tools, but you got to know what to look for. Read Dave's book, Look Before You Learp, because I get questions about that when people come in. I love that when they say, okay, these 2 items, how does that, or 10 items, how does that cover that? I think it's 10, right? Dave, don't you have a list of like 10?
I think it's 8. And by the way, that's an abbreviated list. There's about 25 things your LIRP should have. I chose my 8 favorite for that book. They're about 25.
Sometimes it's just persistence. And I like to tell this story. We have clients who are they're retired now, insurance actuaries. So that this means that husband and wife actuary team, and they wrote these policies. They understand these intimately, honestly say much better than myself. Right. And they came to us and said, they attended a class and they said, we want one of these policies. Can you help us get it? And the wife got approved like that with 0 underwriting. And the husband was, he had crack open heart surgery maybe 5 years before that. And I'm thinking in the back of my mind, never going to happen. Well, we've got a great team who persistently just kept on it. And it took about, probably no exaggeration, 6 or 7 months, but we found a great answer for him. So it's about knowing what to look for, knowing how to handle things, and knowing, what companies to kind of zero in on that work right for you. Because, hey, Dave, your LIRP, cash value life insurance, IUL, is probably going to be different than this guy who had the crack open, heart surgery for different reasons. But it's important. A great question, Andrew. Thank you, because that's such a powerful and important part of the plan. So, Dave, let me ask you this: you always end your presentation with "It's all good news," right? So, what's the good news as we sit here, March 1st, 2023?
Gosh, that's, we've talked about what I think is the good news, and then you've sort of flipped your paradigm since last year. I believe in my heart of hearts that that if you're in the current 24% tax bracket or lower, I think you can probably plan on that being extended another 8 years beyond the date where they implement that extension. So if they implement it this year, 2023, add another 8 years. If they implement it in 2024, add another 8 years. So there'll be a sunset on that. So I think that no matter how much money you have in your tax deferred bucket, if you have 8 or 9 years to be able to execute that shift, and remember what we're trying to do here is we want to shift the money to tax-free slowly enough that you don't rise into a tax bracket that gives you heartburn, but you want to do it quickly enough that you get all the heavy lifting done before tax rates go up for good. So, you know, I think that's good news, that it's not necessarily going to be just a 3-year window. I think it could be an 8 or 9 year window. And like I said before, you know, whatever happens in the future, you know, life happens, anything could happen, but that's what my gut is telling me right now based on what I'm hearing through the grapevine. So that's about as good a piece of news that you can get in the face of what the Congressional Budget Office is telling us about what tax rates would have to do to keep our country solvent.
Yeah, and if I can add to that, if you don't mind, another couple pieces I think are, first of all, the good news is that you're paying attention now and you're listening to, you know, you're on this webinar, you're listening to the weekly webinars, you're following, you know, you're going to follow Dave's podcast and his YouTube channel, and you're going to learn, and you're going to be, you know, you're solidified hopefully in your decisions, and it is an ongoing thing, folks. It can't just like you can't put a financial plan on the shelf. You have to remember you're overcoming 40 plus years of conditioning about, you know, what was told to be best, and we all know is wrong now. So when I talk about reviews with clients in our planning discussions, I often call them reviews and reminders, because we have to remind clients that this is why we're doing this. This is the math. This is what, because people come in and they have an excitement level. Well, I'm going to have $2 million more at age 85 that I can spend, pass on to the kids, anybody but the federal government, without increasing my risk, decreasing my income, any of that. And that's exciting, and they're excited about it. And then they talk to their brother, plumber, friend, or whomever, and they start, or they just forget. And so it's this review and remind. And so knowledge is important, and you're doing that. And we have these great tools for knowledge, but we also have other great tools, and we should thank Congress for the Roth conversion. What a gift that is, to be able to take something that we thought was going to pan out one way. Now we know it's going to pan out another, but we have the choice of what tax rate we can pay to fix the problem for us.
Yeah, let's not get too lovey-dovey about the government. we know that the government, you know, Roth IRAs are the one thing that both the government and everyday Americans love. And it's one of the only things that we both love, because they get their revenue right now and they get to spend it on stuff that keeps them in office. We like Roth IRAs because we know tax rates are going to be higher down the road, and we get to protect our hard-earned retirement savings from the impact of higher taxes. I'm hard pressed to think of anything else out there that where the government and everyday Americans love it, but that's one of those things.
That's why I call it a gift. And you know, we always talk about the I don't know tax rate, because if I can convert my you know, myself, clients at 22-24% instead of the, I don't know what it's going to be, but it's going to be higher than this, it's a gift. So that's all good news too. I appreciate that. Dave, I appreciate you hammering that home. All right, we do have one more question. You okay for a couple more minutes?
Yeah.
Oh, Diane asked, did RMD go up to age 73? And if yes, when it takes effect? So I'll answer that if you don't mind, Dave. So again, 6 or 8 weeks ago, the Secure Act 2.0 became law. That raised the RMD age starting this year to age 73. It creeps up to age 75, but that doesn't come into effect. Maybe you know this, Dave. I can't think of
It's like 2031 or something like that.
Yeah. So it does creep up to age 75, but it's right now it's age 73. Good question, Diane. Okay, Dave, you want to have any comments you want to wrap up with?
No, I think I've spent all my good advice for tonight. I'm an empty vessel, as it were.
Good. I'm glad that we got everything we could out of you. Thanks. It's always so much fun and such a pleasure talking to you, whether it's over webinar or one-on-one phone calls. And I got to tell you, folks, you got to know that there are many times I'll pick up the phone and call Dave. It just happened at least a week ago, I think it was, when someone contacted me about a complete mess that she had gotten herself into with this scheme in another state. And she contacted me, and I called Dave and I said, have you ever heard of this? Do you have any insight on this? And when I tell you, Dave's younger than me, but when I tell you that he's a leader in the thinking of tax efficient planning in this country, I'm not exaggerating, and I put him right up there with Ed Slott. But he talks to a lot of people around the country, and he filled me right in, and we're coming up with a solution for this poor person who was really led astray. So I appreciate that. And Dave always, it seems like you're always working. Sometimes I'll text him late at night and thinking he'll get it the next morning, and the phone will buzz. So I appreciate that. And I appreciate you being here, and I appreciate all the work you and your team do. And I really appreciate you coming up with not only the changing world of retirement planning, because it's talking about a gift, hundreds of people. Since 2017, when I started teaching that course, it's certainly been hundreds of people that have benefited from it. And I love giving out your books, because I never hear a bad thing about it. So it's really beneficial. So I appreciate that, and I appreciate your time tonight. Let me see. I see a couple other questions. It's 7:45. So they're saying thank you. These are thank yous. So appreciate the thank yous. We are going to sign off. On your sign off screen is going to be my contact info. If for some reason you have a question, you want to schedule a strategy session or something like that, reach out to us at admin@attleborowealth.com. There's a lot of great information on attleborowealth.com, where you can see our past webinars and weekly webinars and special webinars. So spend some time poking around in there. Subscribe to my YouTube channel at attleborowealth.com via YouTube for the weekly webinars. Subscribe to Dave's as well. They're really, really good. And he does 2 a week. You do, right?
The Power of Zero is the channel.
Power of Zero is the channel. And then sign up for those podcasts. I don't have a podcast yet. My son keeps telling me you got to do a podcast. I can take these videos and make it a podcast. So that's going to happen sometime in 2023. But Dave has a great podcast, great information. Make sure you listen to it and keep that information. Keep it top of mind. Keep yourself informed. Keep yourself motivated, and get off those railroad tracks and make sure you're in good shape. We have an upcoming class on March 16th, starting at Holy Family University, and Dave's going to be here in Newtown, Bucks County, at the Newtown Theater with our friend Ed Slott on May 16th. And that'll be a great event. So you've got 2 thought leaders in the industry for sure joining us over a couple hours that night. I think we've said it all, Dave.
Yeah. Well, thanks for having me, Mark. It was a great conversation, and I look forward to coming on again real soon.
Yeah, great. All right, everybody. Thanks for joining us. And Dave, take care, and give my best to Felice.
Will do.
All right.
Thanks, Mark.
Yeah, bye.